Thanks for tuning in to Talk ETFs, ETF.com's weekly video series. My name is Sumit Roy, and I'm Senior Analyst for ETF.com. This week, I'm talking with Brian Jacobsen, Chief Economist at Annex Wealth Management. Brian, thanks for joining me.
Thanks for having me.
So Brian, we recently had this really significant Fed meeting where the central bank caught a lot of people by surprise. It certainly seemed like the Fed was a lot more dovish than most people thought it would be, and it even went as far as to project 3 rate cuts for 2024. Were you surprised by what Powell and the Fed said at that meeting?
I was really surprised by it. And so here at Annex, when I was talking to our investment committee before the meeting, I was talking about how we should probably prepare ourselves for a hawkish hold, just the idea that the financial conditions have loosened. We know inflation has come down and that the Fed really doesn't want financial conditions to get too much looser because we've made such big progress on inflation. And when Chair Powell came out with what some people are calling the Powell pivot, the idea that he's beginning to broach the subject about when they might start cutting, that really took me by surprise, and it took the market by surprise. We saw some very big moves in the equity markets and the fixed income markets. It was quite an outstanding day if you were on the right side of the trade.
And we're going to get into the stock market moves, but first, why do you think Powell made this pivot?
I actually think that it was justified. So one of the problems is that I think that the Fed has been really driving by looking through the rear view mirror. And now all of a sudden, it seems like, no, they're beginning to look through the windshield and recognizing that growth is slowing. It's not skidding to a halt, and inflation, that we've made a lot of progress there. I just didn't think that they were going to change their tune at this meeting. I thought that they might have wanted to have laid the groundwork for that at this meeting, and maybe start in January or March, start talking about how conditions have improved enough where they can start considering rate cuts. So it just happened a little bit sooner. And I think that's why I was surprised, is that it seemed like the operating method of the Fed was really to be very backward looking as opposed to being more forward looking.
And of course, the stock market absolutely exploded after the Fed meeting. Bond market surged as well, but let's talk about stocks first. Brian, I want to know whether you think that the rally that we've seen in the US stock market following the Fed meeting is justified. As we're talking, the S&P 500 is creeping up very close to its all-time high from 2 years ago.
I think that we're going to encounter a little bit of turbulence here. I do want to see whether or not we can break that late 2021 high. We're very close to it, and so maybe when this goes out, we'll have surpassed it. Who knows? But to what extent will that serve as some resistance? Because I think fundamentally, corporate earnings have been a lot better than what people had feared. Now, we did have a profit recession, so we actually had 3 consecutive quarters in a row of declines in profits. And then for the Russell 2000, if we look at the small cap stocks, they've been in and out of a profits recession for about the last 2.5 years. So I think that some of the divergence that we have seen between the Magnificent Seven, the top 7 companies in the S&P 500, and the broader market was somewhat explainable by this difference in earnings power. And now, if we do get a Fed who isn't just solely focused on hiking or holding until there is pain, then to me, that does brighten the outlook for the broader part of the market. So I do think that the move up was justified. I'm just not quite sure if the magnitude of the move up was justified.
Of course, Brian, after the Fed meeting, it wasn't just stocks that moved up. The bond market rallied as well, with the 10-year Treasury yield falling below 4%. Where do you think it goes from here? And is it too late for investors to add duration to their portfolios?
That is one of the toughest things out there right now, I think, as far as trying to decide the direction of stocks versus the direction of bonds. Honestly, I think it's harder to think about the direction for yields, mainly because there are so many different factors at work, especially with the debt situation in the United States. One of the big reasons why we got to 5% on the 10-year Treasury was because of the surprise amount of issuance from the US Treasury as far as with the coupon bonds. So it's not just about demand for treasuries. It's not just about growth and inflation. It's also about the supply of debt. And that's a little bit harder to forecast. A lot of that is going to depend upon politics. We are entering into an election year. But in terms of the current state of play and based purely upon more of these demand side factors like growth and inflation, I think that we're probably going to see a move back up towards, say, 4.1, maybe 4.25% on the 10-year Treasury. But then longer term, I do think we could see that 10-year Treasury move down towards 3.5%. So is it too late to add duration? No, I don't think so. Although it is likely that we are going to see some of that volatility, that bumping around over the next few months as people try to get a feel for how things are going to play out with the election.
Well, we're going to have to leave it there. Brian, it's been a pleasure having you on the show. Thanks so much for your time.
Thank you for having me.